All investments require investors, but not all investors are the same. In this video, we'll take a look at the differences between sophisticated and accredited investors. We'll define what they are and how they relate to passive real estate investments. It's natural to assume that anyone can invest in a deal. After all, if you trust someone with your money, that's enough, right? Well, not exactly. We make investments with the hopes of rewards, but all investments involve risk. That risk can affect people differently, depending on their particular situation. Categorizing investors as sophisticated or accredited is required by the SEC. It can help determine the impact of that risk on someone's life should the investment not go as planned. Before we go deeper into the definition of sophisticated versus accredited investors, let's take a look at why they're necessary. By default, any investment offering in the US is considered a security. Securities have to go through the Securities and Exchange Commission, or SEC, for approval, and that can take months or years. To legally sell a security, a person needs to be a registered broker-dealer. This means having a license and being registered with the SEC. Any investment itself would also need to be registered. While real estate doesn't move as fast as something like day trading, most transactions don't have the time to go through a lengthy and expensive SEC approval process. Also, the sponsors of most syndications do not have a broker-dealer license. So for the majority of sponsors like me, we need another way of doing things, and that means looking for exemptions. Exemptions are detailed in the SEC code, which provides rules that an offering can follow to not be considered a security. An extremely popular exemption used by real estate investment syndicators falls under the SEC's Regulation D. There are a few subsections under Regulation D, and most syndications comply with either a 506B or a 506C. So a 506B is for accredited investors and up to 35 sophisticated investors. A 506C is for accredited investors only. Following the SEC's rules means it becomes perfectly legal to have a private offering since they're not considered to be securities. By the way, if you're enjoying this video, be sure to subscribe to this channel so you'll know when I post something new. So what's the difference between an accredited investor versus a sophisticated investor? Well, for such an important matter, and investments are a serious business after all, you'd think the definitions of these terms would be crystal clear, but in fact, only accredited investors are well defined. So let's take a look at that category first. To be considered an accredited investor, you must meet one of these criteria. An individual with a net worth, can include your spouse, of more than $1 million, excluding your primary residence, or someone who in each of the last 2 years had an individual income in excess of $200,000 or a joint income with a spouse in excess of $300,000 and who reasonably expects to continue to reach that income level. I should point out that in August of 2020, the SEC also defined some measures of professional knowledge or experience or certification that can be used instead of just those tests for income or net worth. What counts for being a sophisticated investor isn't as well defined. Sophisticated investors are deemed to be those people who have sufficient knowledge and experience in financial and business matters to make them capable of evaluating the merits and risks of the prospective investment. Now, one person's view of sufficient knowledge and experience might differ from another's, which is why I say it isn't as well defined. Also, unlike an accredited investor, the SEC does not have financial thresholds for someone to qualify as being sophisticated. Now, this doesn't mean that simply anyone counts as being sophisticated. The SEC wants the investor to be able to understand the investment, how to evaluate it, and the risks involved. In my business, I determine sophisticated status through conversations with investors. For example, if I were dealing with you, I might ask you the following questions. How many deals have you been involved in before? Have you ever been in a deal that lost money? I mean, it's happened to everyone at one time or another. Do you know that there's no guarantee that a deal will generate a profit? Depending on the answers to these and other questions, I can be confident or not that the investor is sophisticated. And even though these questions are all covered in documents that my investors sign, I still want to know that they know this beforehand. Okay, so now that you know a little bit more about accredited versus sophisticated investors, it's time to look at the types of deals they're allowed to get involved in. 506B offerings are open to both accredited and up to 35 sophisticated investors. However, a 506B offering can only be offered up to people who have a pre-existing and substantive relationship with the sponsor. So what does that mean? Pre-existing. If a sponsor has a deal under contract, they can't simply meet someone for the first time and in that same moment offer up an investment. They have to have met the person prior to getting the property under contract. Now, what does substantive mean? The sponsor can't just meet a person at a crowded networking event and get their card and start emailing them deals. They need to follow up with the person, get to know them, understand their financial situation, and learn about their investment goals and risk tolerance. A 506C offering can be offered only to accredited investors. The investor's accredited status needs to be verified. This is usually done by a third party, such as a CPA or attorney. The trade-off here is that a 506C offering can be advertised because a pre-existing substantive relationship is not required. So that means that a 506C offering could be presented to someone immediately when a sponsor meets them. One might wonder, if everyone's an accredited investor, is a 506C offering a safer bet? You're dealing with accredited people, right? The exemption an offering is using has no effect on the level of risk in the deal. We don't make sure that the wealthiest people get access to some kind of deal that's guaranteed to work and leave the less solid deals for the 506B offerings. In this respect, all deals are treated the same way. As a deal sponsor, I kind of prefer the 506B offerings because it means I need to get to know the people I'm dealing with and develop a substantive relationship with them, not just getting their business card at a networking event, and that's important to me. Also, the ability to allow up to 35 sophisticated people in on 506B deals helps to level out the playing field, and that's important to me too. I really like the concept of democratization of wealth. When people join my investors club, I spend time getting to know them, understanding who I'm helping, and making sure that we're a good fit for each other. I want to personally ensure that each investor understands the risks before they take part in my real estate investments. But I don't do that only for sophisticated investors. To be clear, everyone in my investors club is vetted by me, even people who are accredited. It's essential for me to be comfortable that I'm dealing with the right people, regardless of how much money they have. At this point, you might be thinking, there's so many rules. Do they really matter? Look, no one ever says, let's have more bureaucracy. But it makes sense that there are checks and safeguards whenever financial deals are involved. Knowing that rules are in place means I get to see people's integrity in action. It's a big red flag when people bend the rules. If someone's going to bend the rules, what else will they bend on that I don't know about? Maybe something in the underwriting? How about the exit cap rate or the rental growth? If someone's playing fast and loose, there's more risk. And I'm not here to gamble like that. Integrity matters to me, and I do deals that have the best chance of working by ensuring that I work with the right people. Am I willing to turn down a deal if I don't have 100% trust in the people that I'm partnering with? You bet. I've actually done that. If you aren't sure exactly what a syndication is, I've got a video that explains it for you. And if you're ready to take the next step in passive real estate investing, join me backstage at Picheny.com.